Four-day winning streak on the S&P 500, attempting to make it day 5. Live from New York City this morning. Good morning, good morning. Futures positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, another Fed official calling for patience. The ECB stuck between a rock and a hard place and hoping the worst might be over in China. We begin with the big issue. Is bad news good news?
Bad news has been good news.
Good news is somewhat bad news.
Bad news is now good news.
It would be really nice if good news could just be good news and bad news could just be bad news.
We're in that mode where the market is cheering weaker economic news.
We had bad news in terms of cooler data on jobs and also consumer sentiment.
The bad news in terms of weak data is kind of good news in the sense that it might mean the Fed is done.
The Fed is going to have some pressure.
Maybe the Fed's going to pause and that allows this cycle to carry on.
In the shorter term, there is some evidence that this is actually working.
That type of environment doesn't tend to last an extended period of time.
We're in this tricky part where you're coming down from really elevated levels and you're normalizing the data.
We need to be careful, though, that we don't get too excited too quickly.
That fine line is going to show.
Bad news eventually becomes bad news.
Let's discuss. Daryl Cronk of Wells Fargo, Joanne Feeney of Advisors Capital Management. Joanne, you've got to translate this. If bad news is good news, what is good news?
You know, John, I think the longer this takes, the better. If we remember where and how all this started, this inflation problem started with the pandemic and started with a shortage of goods, lack of goods, higher prices. We are still working through that problem. And the longer this takes in terms of gradual rate increases or sudden rate increases, but a gradual decline in inflation, the more supply still has a chance to catch up. We are dealing with a U.S. economy that has a fundamental shortage of labor, which is what's keeping services provision tamped down, which is still keeping goods supply tamped down. And that's still fundamentally the problem behind inflation. So the longer this takes, the more patience the Fed has, the more patience the markets have, the more likely it is that supply catches up to demand.
Daryl Cronk, what's the difference between unwelcome downside surprises and desirable downside surprises?
Well, you got to thread the needle, and you need a Goldilocks scenario there, John. I mean, I think what we're seeing right now in the economy is you're moving from a world of lagging to a world of dragging, right? We know that policy, financial conditions, and credit conditions have all have that lag effect, and we've been working our way through it. Now we're actually starting to see it in the data, right? Whether it's consumer confidence ticking down this last month, whether it's the ADP report yesterday and weaker jobs. Even this morning on the PCE, I would say, wages came in less than expected, consumption came in better than expected. I'm not sure that's a great thing. And if you actually look at the Fed's preferred measure of super core, which excludes housing, it's still running over 5% year over year. So we're not convinced the Fed is done here yet, and nor should they be.
Well, growth has been solid. Growth is above trend, and they've talked about the need for a period of below trend growth. Now, Daryl, let's build on that. Stuart Kaiser of Citi has pointed out that upside inflation risks require below trend growth. Now, if that's the objective, do you think equities are priced for that reality?
I don't think they are. I mean, here's the reality. As we sit here today, John, you're sitting at a 19-year high on mortgage rates. You're sitting at a 14-year high on real yields, and you're sitting at a 19-year low on equity risk premium. Equity risk premium meaning, am I getting paid to take equity risk, to your question? Today, I'm just not, right? I mean, we know that all of the return this year has been multiple expansion. Yes, 2024 earnings growth has ticked up to 11% for next year, but you're starting to see even some of the street rationalize that and say, boy, that looks too high to us, and bringing it down.
Joanne, it's that old cliche that money goes to where it's treated best. Is it treated well in equities now?
I think what we're seeing, John, is a real separation of the good stock opportunities and the ones that are overpriced. I mean, look what happened to Dollar General this morning, right? What we're seeing is that investors need to be really selective in where they go. All of equities, the whole market looks expensive on average. But that's not what you need to do as an investor. You don't have to own the whole market. And you can avoid, companies like a Dollar General, which is really playing to the low-end consumer who are most squeezed by inflation and the pace of wage increases, which hasn't really kept up until recently with inflation, whereas other parts of the market are getting rewarded. There is growth out there. It's just not an average that's particularly attractive. But look at the stuff related to AI. That's real. And that's going to grow over time. So there's growth out there, but you have to be really selective in where you go find it.
Dollar General. Let's select that one. Let's bring up the stock just briefly. That stock is getting absolutely hammered in the pre-market. We're down by 17%. Daryl Kronk, is not just them. It's Dick's Sporting Goods. It's Foot Locker. Even Walmart and Target were warning about a softer consumer potentially off the back of student loan repayments resuming later on this year. Daryl, should I listen to them? Or should I look at the broader economic data, which tells me so far so good in 2023?
Yeah, I think that is, you've been asking that question this morning, John, and I think it is exactly the right question to ask, right? Because a lot of the economic data has the lag effects that we know about. We're looking at just this morning, PCE data from July, right? July is, as we get ready to turn into September here, is in the distant rearview mirror. If you look at Dick's, if you look at Peloton, if you look at Dollar General this morning, they're all telling you the same story. The consumer's weakening and weakening at a quickening pace. What I thought was interesting out of the earnings season, too, is if you actually listen to the conference calls, you heard companies like Macy's and Nordstrom's also say that credit card delinquencies were rising, right? So not just the slower spending numbers and slower revenue and sales, but actually we're seeing deterioration in the credit conditions and the repayment side of it, which tend to be more at the high end of it. So I think you're seeing it broadly across the retail board. I would take that canary in the coal mine and listen to it. I wouldn't dismiss it.
I'm loving some of the research out there at the moment, and I'm going to bring you two quotes, one from Morgan Stanley and a counterpoint from Renaissance Macro and Neil Dutter. This from Morgan Stanley on Barbenheimer and Taylor Swift. They said real consumer spending is tracking 1.9% quarter-on-quarter annualized growth in 3Q23. They estimate Barbenheimer, Taylor Swift's The Eras Tour and Beyonce's Renaissance are combined contributing 0.7 percentage points to consumption growth this quarter. They think that's going to fade in the quarters to come. It's the end of the Barbenheimer bounce. This is what Neil Dutter's got to say back to that this morning. There was quite a bit of enthusiasm for Barbie and Oppenheimer, which were both released in July. However, real spending in motion picture theatres remains about 11% below its level 3 months ago. Not sure we should expect much of a drag later as a result. Joanne, with all of that in mind, jokes aside about going to the movies and paying too much money to watch Taylor Swift, where is that drag coming from the consumer that so many people are anticipating into year end?
Well, it's pretty clear that even though real personal income has been rising over the last, about year, it's still the case that consumers are burning through their savings pile. And at some point, they have to face reality of dealing with those higher credit card bills, which they are now facing, higher student loan costs as they have to begin to pay some of that back. So I think it's the drawdown of savings that partly is the headwind. It's the pile up of inflation, right? Inflation isn't reversing. It isn't becoming negative. Those prices that have gone up are still going up. They're just going up at a lower pace, which means that it's still more costly to meet your expenses every month. So all of these things are going to weigh on consumer spending and cause that shift, towards necessities that we've seen start, and we've seen in the reports of Target and TJ Maxx and Walmart, right? And that ultimately could then finally affect the services side of the economy. We haven't seen much of it yet, but we're likely to see that as the next area where consumer spending starts to fade a bit.
20 minutes away from the opening bell, equities fading just a touch here. We're still up by 0.1%. Tons of data this week, job openings, the ADP report, claims this morning, payrolls tomorrow. Mike McKee has it all. Morning, Mike.
Morning, John. You asked a little bit earlier whether good news is bad news or vice versa. Well, I've got an answer for you. Both. You take a look at the PCE numbers today, the inflation gauge the Fed follows, and you see on a month-over-month basis that both core and headline rose just 0.2. You can see the trend down. That's what the Fed is looking for. But Darryl mentioned the super core number. That went up. That's Jay Powell's number with services, core services ex housing, and that went up 0.5% during the month, and it is running around 5% for the year, so it is still significantly higher. What does that mean for the Fed? Well, they'll be looking at all these numbers, and one of the things they will be worried about is personal spending. Even though incomes went down, spending went up by 0.8% more than expected, certainly more than the prior month. How are they doing it? Well, that was the question that was just asked. Look at the savings rate. Drops to 3.5% from 4.3%. So does that suggest that consumers are going to be pulling back? We're going to have to see if wages go down, wage increases go down, and savings go down. Then we'll look for those credit cards to see what they're doing. The other number out today that everybody's been watching is jobless claims. We have obviously the payrolls report tomorrow. Jobless claims, very interesting. I put continuing claims up here because they have barely moved as well. And what you can see is that every time you go into a recession, continuing claims, and the same is true for initial claims, are rising significantly. Take a look on the right-hand side. I took out the pandemic number because it throws the scale off so much. But if you look at where we are now compared to where we were going into previous recessions, it is not a worrisome sign. There is still labor hoarding going on. We may be hiring fewer people. We'll find out at 8:30 tomorrow. But we are not letting them go in any significant number. And those who do let go are apparently finding new jobs.
Mike McKee will be here at 8:30 tomorrow.
I'm the only one.
Mike McKee will be.
Tom.
No, TK wants everyone to know that Tom will be here as well. Mike McKee.
Taylor Swift will be here.
Taylor Swift too.
And everybody tunes in, right?
Beyonce, everyone. Max Verstappen. Who else we got, Mike? Mike, thank you. Wanted to go to this, Daryl Cronk. This from you, a stat. You say history shows the S&P 500 doesn't bottom until on average 6 months after the first Fed rate cut. Now, Scott, is that just a nice, interesting stat, or are you making a forecast? Daryl, rather, please.
I mean, that's historically true. Oh, yeah, sorry, John. That's historically true. It's happened almost every time. And it makes sense, right? Because what happens is the yield curve bull steepens as people project that the economy's slowing quickly, economy goes into recession, Fed has to cut rates. And then what happens is equities tend to bottom after the first rate cut. Most people miss that. You can fact check it back for the past basically 13 monetary tightening cycles since 1970, right? Every time it's almost happened. So if you price the first Fed rate cut out into 2024, we still might have a long time here before we start to see where the equity cycle ends up. And just to the point, John, I think Mike McKee just nailed it. I mean, he was spot on exactly the super core and the assessment. And labor is key as we head into Labor Day, right? The economy needs to labor on or we're going to have labor problems.
Daryl, I think we've been talking about that low in October for so long. I forget that it's almost been a year. It's September this weekend. It's tomorrow.
Yes.
We're 11 months into this and we've been talking about retesting the low. Daryl, do you think we really could retest the low of last October?
I think it's a stretch to get down to that 3,600 level. And if it did, it would probably be a generational buying opportunity, John, to be frank, right? Because valuations and your risk reward would flip so strongly and there's so much liquidity out there that your buyers would step in heavily. But I do think, where we do our work and analysis, we say the risk reward starts to flip somewhere around 41 to 4,200, meaning at that level or below, equities start to become attractive again based on earnings and valuations and the equity risk premiums I mentioned before at a 19-year low, meaning I'm not getting paid to take equity risk at 4,500 today.
Daryl Cronk, Joanne Feeney, sticking with us. More still to come. We'll talk about China and the ECB and global equity markets as well. Local equity markets, stateside, the S&P 500 just about positive here by 0.1%. Going into the opening bell about 17 minutes away. Let's get you some movers. Here's Abby.
Hey, John. Well, we are looking at a fifth update potentially for the S&P 500, the longest winning streak since the middle of June. Helping out right now, Salesforce.com. Shares are popping higher, sharply higher after the company put up a very nice beat. They beat earnings by 12%. The sales numbers were fine. It looks like their cost-cutting campaign has really eased fears. They've also raised the full-year view, profit view, and margin outlook. So right across the board. And if you recall, earlier in the year, activists were really pushing for this kind of improvement. They got it. Okta, the application software company, they beat top and bottom line estimates as well. They also raised the full-year view. There's margin improvement there, and apparently the company's sales strategy, the street likes it a lot. That stock up about 10%. Now, there's one here who clearly does not look like the others. Dollar General plunging down 17.3%, a miserable quarter. Adjusted, yes, very brutal. Adjusted earnings missed, the rising labor costs, and of course, they slashed the outlook again, John.
Amazing. Abby, thank you. A fifth of the market cap going just like that. Expecting that to happen around the opening bell. We've seen that with several high-name big name, big brand retailers over the last week or so. I'm thinking of Dick's Sporting Goods, Foot Locker and a world of pain over the last couple of weeks off the back of earnings. Coming up on this programme, Eurozone inflation, keeping the pressure on the ECB.
We have more slowdown than the US, but still with more inflation. And that's the conundrum for the ECB. We can see that the economy is not doing well at all. Germany was in recession at the end of last year, beginning of this year. But people have not yet seen the impact truly on the labor market, and wage negotiations remain very, very tense.
The latest on the ECB, on Europe, on China, coming up next.
The way I think about China right now is one word, and that word is traction. So when are all these little drips and drabs of policy going to actually, kind of do their thing, get traction, and move the economy forward? One, PBOC is injecting liquidity. Two, stocks trade cheaper to the U.S. than they have in 20 years. Three, there's no confirmation in this negativity that everyone seems to love to talk about. The consumer in China is not like hiding under a rock. They have plenty of room to consume. It is a confidence issue.
Jay Pawlowski of TPW weighing in on China's recovery. China's manufacturing contraction easing just slightly, as some investors say relief for equities could come soon. This is Eurozone inflation showing no signs of letting up. The consumer prices rising in August, presenting a problem for ECB officials as they weigh the risks of a September pause. Team coverage starts right now with Bloomberg's Enda Curran in Washington, D.C., Maria Tadeo over in Brussels. Maria, let's start with that data out of Europe. Rock and a hard place for the ECB and Christine Lagarde.
Look, and it is so tough for the European Central Bank at this point because it really is a real conundrum when it comes to the economy. And of course, we know this is a single mandate central bank and they focus on inflation, of course, at 2% target. They also keep an eye on the macro data. And we know the risks are all pointing to the downside for the euro area. When it comes to the inflation data today, you did get headline inflation come in at 5.3%. The estimate was that it was going to cool more than expected, but we saw that was not the case. I would add, however, a caveat to that headline inflation number today, because if you look at some of the drivers behind it, a lot of that had to do with energy and fuel. That was the case for the Italian print, it was the case for the French print, and it was the case for the Spanish print. So we know the European Central Bank will probably skip through that. When you look at core inflation, again, it's 5.3%. The European Central Bank would love to see that way lower, but that is where we are. Nonetheless, when you look at components inside it, you could argue it is moving in the right direction, just not fast enough. And fundamentally, Jonathan, the real question here, and that decision will hinge entirely on this question, is whether the European Central Bank believes the transmission is working enough so that every hike they've done until now can get inflation back to 2%. If they believe that is not the case, then there is still that possibility of a hike in September. I would not rule it out, and I do not think the data that we got today has flipped it either way.
Europe doesn't just have an inflation problem, it has a growth problem too. And the blame game shifts to China for the global economy, particularly over the last month or so. Enda, can you help frame for us the latest data out of China and the policy response to it?
So the PMI data, the official PMI data is showing some improvement, John, nudging towards 49.7, suggesting that maybe the manufacturing side is bottoming, new orders picking up, construction doing well, perhaps suggesting a turn in the global trade cycle. That's the good news from the PMI. The bad news is the services side of the official reading still pretty weak. We know ongoing turbulence in the credit markets for those big property developers, more negative news on the property developer Country Garden overnight. The authorities coming out with fresh steps as well to bring down the cost of down payments on properties and, of course, on repaying mortgages. There is, though, a body of thought emerging that the doom and gloom on China's economy is overdone, that China's stock market, for example, is now a buy, that there is value there. So those bulls are pointing to PMI as potentially a bottom, but you'd have to say on the real estate side, we don't yet see any signs of a turning point.
Enda, thank you, sir. Alongside Maria on the latest for the data worldwide. Daryl Cronk, Joanne Feeney back with us. Joanne, it's not just the data in Europe. It's not just the data in China. It's the inability seemingly to respond to it, particularly in China. And China, to go one step further, Secretary Raimondo talked about the lack of predictable regulations in China. Is China investable from your standpoint?
Yeah, it's definitely a challenge, John, for a lot of reasons. I mean, one is for what Commerce Secretary Raimondo pointed out, which is that the unreliability of the government's policy towards the private sector makes a risk hard to assess. And so one has to be extremely careful about picking and choosing one's spots, hopefully finding companies that are less, in the view of the Chinese government as sensitive, to their cultural stability needs. I think that is an unpredictable risk, and that makes it very hard to invest. But again, you can pick your spots. I think more broadly, though, John, the concern, and I think the unrealistic hope of some investors may be that China's growth is going to suddenly return to prior levels if only the government does the right things in terms of stimulus. And that is, I think, a fundamental misunderstanding of what has been driving growth in China over the last decades and where it's likely to go from here, which is lower.
What a tough backdrop. Daryl Cronk, final word, please.
Yeah, I think that's exactly right. I mean, when you look at China, it's in the midst of a property crisis. Activity is faltering, prices are declining, growth is slowing, right? So it makes it really difficult, John, to get excited about putting money to work there. I think the Chinese government is trying to shift the stimulus conversation from a macro, big China government stimulus to the local stimulus conversation. But I would steer clear there now. I think it's difficult to make a good case. And then on Europe, I would just say one word: stagflation, right? Really slow growth, high inflation. It's a conversation nobody wants to have, but it's the reality of what Europe is dealing with right now.
Daryl, thank you, sir. Spent the last 15 minutes trying to work out why I called you Scott. I still don't know. Daryl, I apologise. It's good to see you, as always. Daryl Cronk, Joanne Feeney, thank you. Coming up, the morning calls, and later, JP Morgan's Jack Caffrey with the market on a 4-day winning streak, attempting to make it 5. Your equity market up by 0.1% on the S&P 500, just a day away from payrolls in America. Five minutes away from the opening bell and trying to make it a 5th day of gains on the S&P. Equity futures on the S&P right now positive by 0.1%. That 4-day winning streak, the longest since the middle of July. Let's see if we can make it 5. That's the price action. Here are some morning calls. First up, Morgan Stanley upgrading 3M to equal weight, 113 price target, seeing improving fundamentals and achievable consensus margins. JP Morgan downgrading Hostess Brands to neutral, $28 price target, citing media reports about the company potentially being for sale. That stock is unchanged. And your third and final call from Wells Fargo, downgrading Victoria's Secret to equal weight, $18 price target, pointing to unfavorable sales trends and share dynamics. That stock is down by another 3%. We'll be talking about Dollar General absolutely cratering going into the opening bell after they cut their outlook. We'll have that story around the open in about 4 minutes' time, and we'll catch up with this man right here, Jack Caffrey of JP Morgan. Your opening bell up next. The economic data so far this week doing no harm to this equity market. S&P 500 futures just about positive by 0.1% on a 4-day winning streak on the S&P, about to make it 5. And the S&P trimming a monthly loss down to about 1.6%. 1.6% is nothing really at all, given the grand scheme of the rally so far in 2023. Let's your opening bell, switch on the board and get to the bond market. The harm early this month done by surging bond yields. Over the last week, a whole lot lower. Down another basis point this morning at 4.1%. Remember, a week or so ago, a week and a couple of days, 4.36 on a 10-year, all the way back down, sub 4.1. Earlier on in the last 24 hours. On a 2-year, quite a range this week, from 5.1% all the way back down to the 480s. On a 2-year right now, 4.89%. In the FX market, euro weakness. This is a problem. The euro against the dollar, 108.64. This is a problem for ECB President Christine Lagarde. What does she do on September 14th? Stuck between a rock and a hard place. That rock, sticky inflation, that hard place, growth, just ain't good. In the commodity market, just briefly, about 83 on WTI, an 82 handle, just short of $83 a barrel. Brent crude at the moment, WTI there, up by a little more than $1. One stock to watch at the open, Chewy. Evercore downgraded the stock. Analysts saying, quote, what makes us incrementally cautious is the disappointing second quarter decline in net adds, as well as management's subdued outlook for the second half. Abby has more. Hey, Abby.
Hey, John, and it's very disappointing to investors, too, with the stock now down about 11%, heading to its worst day since May of 2022. So they missed earnings in a huge way, down 61%. They put up at 4 cents, literally 4 cents in adjusted earnings. Sales were about flat, but yes, disappointment on the part of the street that they would, Evercore ISI, as you were just mentioning, in particular, would prefer a more compelling valuation level, which is a way of saying that the stock is too expensive for the numbers that they're putting up. Morgan Stanley has kept their equal weight rating, saying that the negative net adds in the second quarter were offset by better than expected profitability, but the net adds have continued to disappoint, and the risks largely priced in ahead of the results. Well, I would disagree with that, considering that, again, that the stock is down about 11% on the year or on the day, on the year, down 26% into today. So these results aren't shocking, but just disappointing to the street. I would add one more thing, John, which is there's a 17% short interest on this stock. So some investors today doing very well. These are probably the results that they would expect. It's also interesting just to think about all of the commentary out there about how Chewy.com is taking so much business from the smaller pet companies. And yet, from a profitability standpoint, they're really having a hard time here, and from that net ad standpoint.
Stock down 11%. Abby, thanks for that. About 2 minutes into the session, fifth day of gains on the S&P 500. Longest winning streak will be closed here, going all the way back to the middle of June. No drama at the headline level on the S&P, just an inch higher by 0.1%. You want some drama? Check out this. Dollar General cutting its profit forecast for the second straight quarter on rising labor costs and softer sales trends. The CEO saying this: while we are not satisfied with our overall financial results, we made significant progress improving execution in our supply chain and our stores. Simone Foxman, that stock down 16%.
Yeah, shares fell about 20% last time it missed earnings last quarter, and this is the biggest drop since then. We're at the lowest level since March 2020 here. The results really pretty ugly. In the second quarter, comp sales actually fell slightly by 0.1%. They were anticipated to rise about 0.9%. The thinking that more people, a troubled consumer, would trade down and go to Dollar General doesn't necessarily seem to be so, because revenue from really all segments came in less than anticipated. But I think what really analysts are focusing on here is the guidance. Inventory has been on the rise, up about 8.5% from a year ago. The company saying it needs to invest there, also invest in labor to eliminate shrink, make the shopping experience better. All that is going to add up to a $170 million charge in the second half of the year, and therefore we see comp sales for the year expected to be either between -1% to 1%, where we were previously looking for 1% to 2%, and the street was expecting $10.03 a share. Now the company says $7.10 to $8.30. Paul Lejuez of Citi says this is a much bigger cut than we had anticipated, even though we did see one coming.
Simone, thank you. Stock lower by 16% about 4 minutes into the session. I want to turn to Shopify. The company striking a deal with Amazon to allow merchants who pay for Shopify's e-commerce tools to use the Buy with Prime logistics network. An Amazon executive saying this: we're excited to help merchants not only grow their businesses, but also save time and resources. Katie has the story. Hey, Katie.
Hey, John. Yeah, Shopify soaring on the heels of this news, currently up about 6% from the bell. Now, with this tie-up, Shopify's U.S. merchants will be able to tap into Amazon's logistics network via its Buy with Prime tool. Specifically, that allows merchants using Amazon's payment and fulfillment services to include the company's checkout services and shipping guarantees on items that are sold on their own sites, which is interesting. So Amazon, it launched Buy with Prime last year, and at the time, this was seen really as an effort to blunt Shopify's momentum. But obviously, the optics a little bit different this morning. Now, the sell side broadly positive on this deal for both companies. Citi notes that this further enhances the value of a Prime membership, while you have Oppenheimer's Ken Wong saying that this should improve Shopify's merchant fulfillment experience. And as such, you can see both companies up this morning. Shopify, again, up about 6%.
Katie, thank you. Moving higher on that stock, turning to another earnings story, Salesforce, easing concerns about a slowdown, giving a revenue and profit forecast that topped estimates. However, Citi analysts saying the software company is, quote, not out of the woods yet, particularly with a continued tough macro environment. Ed has more. Morning, Ed.
Yeah, good morning, Jonathan. Salesforce up 5.8%, holding its early gains from the open. The story really clear. Salesforce and CEO Mark Benioff really focusing on profit, listening to activist investors, which has been a story over the last 12 months. In July, Salesforce raised prices for the first time in 7 years. Job cuts have started to take effect. Salesforce talks about how headcount will be down 10% by the end of the fiscal year. And broadly, analysts are focusing on the outshining and performance of operating margins versus the slowdown in top-line growth. Revenue of $8.6 billion in the fiscal second quarter just gone represents year-on-year growth of 11%. Going to Citi's point, John, this is a company that on the top line has historically grown between 20 and 30%. There is a concern about growth long-term, but adjusted EPS of $2.12 per share, above analyst estimates of $1.90 a share. In June, Salesforce announced this new suite of artificial intelligence-backed tools. The per user, per person cost $7,700. So you go to the forward-looking guidance. For the fiscal third quarter, the period ending October, they see sales $8.7 billion, which is slightly ahead of what the street thought. But for the full fiscal year, they've also upgraded their forecast for sales of $34.8 billion. And key to what the sell side latched in on, operating margins have been boosted by 2%, full year fiscal operating margin 30%. Sort of symbolic, at the beginning of the year, Bain Consulting carried out a strategic review of this company. It's now closed and finished, and the company kind of hinting that this is a part of the result that you're seeing.
Ed, thank you, mate. Stock is up by almost 6% right now, 7 minutes into the session. Here's a bullish view on the name from Dan Ives of Wedbush, raising his price target on the name from 240 to 255. Salesforce came out of the gate swinging, featuring a Djokovic-like performance. Classic Dan Ives. Strong Salesforce numbers and outlook is a huge barometer for the overall IT spending environment, with the street coming away with a more bullish vibe with the last few quarters. That stock is up by 5.4% to 226. Dan Ives at 255 now from 240. 8 minutes into the session, broader story, S&P up for a fifth day, this time by 0.25%. Jack Caffrey looking at the move in bond yields, saying this: all markets seem to be living in and reacting to the bond market's mood swings. The axis since shifted most recently to the idea of getting ahead of when the Fed calls it quits, with its hawkish rhetoric, forecasts and dot plots. Jack, I'm pleased to say, joins us right now. Jack, wonderful to catch up with you, sir. Let's start with the dividend growers. I know you like those names. Why is it a good time to shift to them right now?
Well, I think at the margin, if you start coming back to dividend growth, you're moving yourself away from the more extreme tails of the market, either the high secular growth names with embedded high expectations, and that to some extent might require a continued slowdown in the economy and a more dramatic decline in interest rates from here, or from having to make a call on whether economic growth actually reaccelerates that tends to drive the deep cyclicals. So if you will, dividend growers can be almost more core than core within the broader equity market and take away that need to be right on the timing, which has, I think, been troubling for a lot of people this year.
Jack, isn't there a bond market call embedded in your call on dividend growers, though?
There is a yes, to the extent that we now live in a world where dividend yields are below bond yields. There is something there. But if you come back again by focusing on growth rather than dividend yield,
got it.
And so many investors conflate the two. When you think about dividend yield, most investors actually are saying high dividend yield, and those are like buying bonds. And if you're buying that sort of stock that has like 2-3% dividend growth, you actually haven't been keeping up with inflation over the last several years. And so you have certainly seen those stocks behave more like bonds than like stocks, places like in the utility sector and some consumer staples. Coming back to perhaps lower dividend yields, but where dividends are growing at 7, 10, 11% a year, you actually wind up better protecting your purchasing power in an environment of still stubbornly high inflation against what the Fed would like it to be. And when we might start talking about how close to 2 is 2, is 2.4 close enough to 2 for the Fed to say we've won? And so come back to this idea that if I can double my dividend over 7 to 10 years, actually you get growth income. And I think that's what really drives purchasing power protection and ultimately becomes very powerful in the stock market over time.
Jack, you and I have talked about housing and the housing sector and the names around it that benefit from what happens there. This story now, this bullish thesis around home builders is so well understood, given the distortions in the mortgage market. Jack, where are you now on that call for the home builders and the names that work with those names?
Well, I think when you look at the home builders themselves, to some extent, it gets a little trickier here just because they effectively, they're helping support their sales by becoming bond traders themselves, effectively offering a buy down of current mortgage rates, tacking that onto your purchase price. But you can only do that for so long if interest rates remain sticky before you start having some more problems. But they really are the only material supply in the market. And so for someone who has to find a house or is moving or just is outgrown where they are, you're basically forced to look at new construction. I do think, though, that home improvement actually probably has more legs than people think, because this can become really the renovation economy. If you're looking at the average mortgage, 3.5% against a headline mortgage of 7%, you start thinking it becomes easier or more economical or more efficient to actually renovate your house, maybe add an extension than it is to actually take on a whole new mortgage, assuming you could even find inventory to buy. And so much of what I hear about is being cash buyers. So people aren't even interested in the mortgage market because they're being outbid for people who actually are desperate to find that new house, admittedly more in the suburban New York market, and where home builders really dominate, say, the southern markets where people have been moving to.
So, Jack, if we're in the renovation economy, can you help me understand the companies exposed to that? Is this the Home Depots of this world? Is it a company in the materials business? Where am I getting that exposure?
I think that you wind up actually, again, the easier exposure is the safer at night exposures wind up being the home improvement chains, which can actually benefit from, strong comps. A lot harder to have shrink when you start thinking about it's hard to carry a 2x4 out and not get noticed walking out the front door. When we think back to what we've heard over the last several days from retailers, whether it's in the discounters or other large retailers they continue for a year now. We've been talking about shrink this and shrink that. Harder to do with plywood and 2x4s. Now, I think when you start getting into the actual mechanics of what it winds up being sold, you do have issues with respect to supply chains still being unkinked within that. So I'd rather go more with simpler and easier trades where I have to get one thing right. People are fixing their houses rather than trying to guess whether it's paint, whether it's cabinets, whether it's plumbing fixtures. That gets a little bit more granular than my ability to actually make that right call all the time. And so I'd make it simpler and go to home improvement and get the broad theme right rather than having to be specific.
Jack, what you just said on the retailers, too true. I'm thinking of a name right now. I'm looking at Dollar General on the screen, down by more than 16%. Is your message, maybe not just for this name, but names like it, steer clear?
It's not steer clear, but on one hand, I'm not sure why the street is surprised by the Dollar General news this morning after the Dollar Tree news last week, which also reported many of the same themes and saw almost a comparable price decline. And I think you also then think about that and bringing this back to what's an investor's horizon. Because clearly retail has been troubled, and it's been troubled for more than a year now, going back to Target almost a year and a quarter ago when they began talking about having challenges around inventory and having a mismatch versus what the consumer suddenly wanted. And when we now have higher gasoline prices effectively pushing and pressuring that lower end consumer. The flip side, though, is when you think about places like the discounters, the dollar stores in particular, they are more rurally oriented, and we are, as a U.S. government, is dropping $1 trillion on those rural economies, which should ultimately be good for wages, should be good for jobs, and should be good for sales for those retailers left in those markets.
Jack, appreciate the update.
Not everyone can be served by Shopify.
I always do. And I'm going to be thinking of that line about not being able to walk out of Home Depot with all that stuff. Jack Caffrey, thank you, sir. Appreciate it. About 15 minutes into the session, equities up by 0.1%. Coming up, American Airlines flight attendants voting yes on a possible strike.
All of these strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages.
Team coverage up next.
All all of these strikes and wage negotiations are a really important reminder that labor supply is still very constrained. Workers do still have a lot of bargaining power for higher wages. So even if we saw softer jobs numbers, it could be because of strike effects. It could just be because we are in a tight labor market. We're running out of people to hire. Labor supply is still an issue here.
That was Citi's Veronica Clark weighing in on labour market conditions. American Airlines flight attendants, just the latest group voting yes to trigger a strike. The union writing this: "We are long overdue for a new contract. We are ready and willing to do what it takes." Votes tallying over 99%, paving the way for a possible walkout as early as November. Let's get to the team coverage. Bloomberg's George Ferguson with us from Detroit alongside Anne-Marie Hordern in Washington, D.C. George, first to you. We dealt with the pilots. Now we've got to deal with the flight attendants.
Yeah, so that's another agreement that's pre-pandemic as well, right? So it's waited a long time. The attendants look like they initially want a 35% increase, even higher than what the pilots were getting. I tend to think that's a bit too high. I realize that they're not as well paid as the pilots and they probably want some catch up, but it seems to be a bit too high. It's probably less of an issue for the airlines. I mean, there's the pilots, we think they're about 25-30% of all labor costs. Flight attendants are going to be much less than that. They're probably sub $1 billion at an airline like American. That's probably going to make $2.5 billion this year. So to give them 30% is not going to add a lot to expense, but it's a continuing drumbeat at the airlines, right? There's a lot of unionized workers at the airlines. They all want increases, and it's adding up, right? It builds into the expense base, doesn't get unwound. It creates continued cost challenges.
George, just how understaffed are some of these companies, and have they learned to do a whole lot more with a whole lot less over the last couple of years?
So, I mean, I think it's really hard to do more with less, right? And especially the attendants, because the attendants are regulated by the FAA and the number you have to have on an airplane for it to operate. So you can't operate understaffed, but there's been a fair amount of turnover. And I think the challenge really at the airlines has been rehiring and then getting the training up to the point where they can operate at the efficiency that they were doing in 2019. I don't think they're there yet. They've gotten a lot better. I think turnover has stabilized to some degree, but again, more to go to get them back to 2019 levels of productivity.
MH, we talked about this a million times. It's like another day, another threat of a strike in America.
Yeah, that's right. It's really a hot labor summer. And what you're seeing is, as the economist pointed out, that you have a tight labor market and the unions are using this to try to make sure they can get better leverage when it comes to contracts. I mean, you look at potentially this strike, it wouldn't happen until early November. There's also federal law, Jonathan, that makes it very difficult for airline unions to actually legally strike, and the president and Congress could get involved. But it was almost unanimous. More than 99% of these airline flight attendants voted to authorize this strike. And what you hear from the union is that they say that this is a message to the executives at American Airlines that flight attendants are fired up and they should take this strike authorization at their peril. So what they're really doing is just upping the ante and having that leverage to go into these negotiations.
Cameron Dawson called it hot girl summer. AMH, is that your line? Hot labor summer?
Hot labor summer. That's my line. It's even now an Urban Dictionary because the individual who gave Biden and helped him coin the term that he wanted to be the most pro-labor union president in modern history, he kind of shrugged me off when I said, hey, it's a hot labor summer. And he's like, I don't believe what you're saying. I don't really believe that. But it's true. Look, we potentially might have auto workers striking as soon as September 15th. We still have the writers and the actors striking in California. We just had the UPS Teamsters. We just had the airline pilots. It is a hot labor summer, and it's in the Urban Dictionary.
MH, there we go. I'll be using that line. I'll be borrowing it and citing you every single time. Anne-Marie, thank you. Alongside George Ferguson. About 23 minutes into the session, up here by 0.2% on the S&P with a sector price action. Here's Abby.
So not a lot of drama here for sectors, John. On the day, we are looking at a fifth update for the S&P 500, possibly the longest winning streak since the middle of June. Right now, we have the best sector is communication services, followed by tech and discretionary, but none of them up more than 0.5%. Staples is the worst, down 0.3%. We also have healthcare down there. So the fact that the defensive sectors are down is actually risk on. Now, on the month, it's just so interesting what we're looking at. Most sectors are lower on the month. Energy and healthcare are the two sectors that are higher on the month. And then to the bottom, we have utilities. As you had mentioned the other day, utilities getting absolutely killed. But tech, John, really making a comeback at this point now, down just 1% or so.
Abby, thank you. Your trading diary up next with payrolls just around the corner. 5-day winning streak on the S&P. Stocks gaining across the board here. Let's get you to the trading diary. Broadcom earnings coming up after the close. Friday, the main event, it's the payrolls report. We'll hear from the Fed speakers, Bostic, Mester, through the rest of this week. Remember, Monday, US markets are closed for Labor Day, as if you needed a reminder. I'll be away tomorrow. I'll be watching payrolls come in, of course, from wherever I am. I'll catch you after the long weekend. I'll see you Tuesday from New York City. This was the Countdown to the Open. This is Bloomberg.